Take a look at the live screens flashing across financial terminals right now, where Metals Corp, trading under the ticker CRML on the NASDAQ, commands attention following a sharp upward surge, hovering near the $7.11 region, while retail sentiment on social media platforms like Reddit and X chases the usual high-beta semiconductor darlings and fleeting meme assets. A massive structural blind spot is unfolding right beneath the market's nose. Standard financial media loves to frame the global green transition and defense modernization through the lens of downstream assemblers, EV manufacturers, robotics firms, and aerospace primes. Yet they completely miss the brutal geological and geopolitical bottlenecks at the absolute bottom of the supply chain, the absolute monopoly chokehold on heavy rare earths and battery-grade lithium. Investors tracking everyday tech stocks fail to realize that without secure, non-aligned access to materials like dysprosium, terbium, and unrefined eudialyte-bound heavy rare earths, the ultimate supply chain gatekeeping, institutional heavyweights are quietly positioning themselves to control, while retail traders get shaken out by short-term volatility. Underneath the surface of daily trading volumes, the price action of CRML reveals a classic institutional accumulation pattern, masked by macro jitters and skepticism surrounding early-stage resource development. While retail investors panic sell during minor liquidity pullbacks, institutional capital blocks are methodically absorbing float, acutely aware that the Western world is running out of time to decouple its critical mineral dependency from foreign processing hubs. The macroeconomic crosscurrents, ranging from shifting interest rate expectations to fluctuating commodity indices, frequently trigger algorithmic sell-offs that retail traders mistake for structural weakness. In reality, these dips are engineered liquidity events where smart money establishes positions in strategic assets. Think about how many shares you are holding in your own portfolio right now, or if you were sitting on the sidelines waiting for a deeper macro correction before taking a serious stake in the raw material backbone of the next technological supercycle. To truly understand why Metals Corp commands a vastly different valuation narrative than legacy mining concerns, we have to strip away outdated historical framing. Traditional mining is often viewed as a cyclical, low-margin, capital-draining business tied strictly to old economy construction cycles and traditional fossil fuel demand. But CRML represents an entirely modern paradigm, a strategic geopolitical asset holding company bridging the gap between Western industrial demand and secure extraction nodes. At the core of its operational framework are Tier 1 assets like the Wolfsberg lithium project in Austria and the massive Tanbreez rare earth deposit in southern Greenland. Tanbreez, in particular, is not your grandfather's remote, high-cost, environmentally devastating mine. It features an exceptionally favorable geological setup where an open-pit operation sits adjacent to a deep, ice-free fjord, enabling direct shiploading without navigating complex regional choke points. Furthermore, the coexistence of easily marketable construction-grade minerals like feldspar and arvedsonite helps offset operational expenses, while the eudialyte ore delivers an extraordinarily high concentration of heavy rare earth elements, the critical building blocks for high-performance permanent magnets required in advanced defense radar, missile guidance, robotics, and high-efficiency electric vehicle motors. Looking toward the multi-year horizon, the catalysts lining up for Metals Corp make it one of the most asymmetric risk-reward propositions in the junior materials sector. As the company advances its operational timelines, including strategic consolidation moves like securing 100% control over the Tanbreez asset through its European lithium transaction framework, the pathway toward commercial production over the next few years becomes increasingly concrete. The technological gatekeeper positioning here cannot be overstated. Western megacap tech spenders and defense contractors are under immense regulatory and sovereign pressure to purge non-allied materials from their supply chain. However, this transition is fraught with execution risks, ranging from capital expenditure inflation to permitting hurdles to dilution management and complex metallurgical processing engineering. Yet when viewed through the lens of secular demand driven by the global energy transition and surging national security budgets, these near-term friction points pale in comparison to the macro reality.
Looking past short-term price noise is no longer an option for forward-thinking investors. It is the absolute prerequisite for capturing generational returns before the broader public wakes up to who truly controls the physical building blocks of the modern tech economy.